hearing today. I know Dow Jones Newswires was saying that there was a heavy offshore selling of the SPY 200 futures. So just explain to us how that impacted our market today.
Massive action in the futures market, so huge amounts of volume going through, and of course the market moving down lower, so it does look like there has been selling in terms of the Australian equity markets, short positions in terms of the SPY futures and the futures market, and of course a negative reaction in terms of the Aussie dollar. The trade at the moment from offshore investors tends to be short the Aussie dollar and avoid commodities, and that was certainly seen in terms of the Aussie share market, where the most painful space to have been today was the material space, where we saw BHP down almost 2%, Rio Tinto was down about 3%, and Fortescue was down by 4%. I think compounding the pain that we saw in that space is that we've seen a number of mining services companies now out with profit warnings this week. On Monday it was coffee. On Tuesday we heard from Chandler McLeod, which is a recruiter to that resource space, and then today from United Group as well as from Sedgman. So a lot of concern around that area, and that was really played out on the market today. So that weaker Australian dollar, which is usually good news for the Australian share market and good news for earnings, was really more a symptom of offshore selling today, because if we do see offshore funds selling, they're usually repatriating currency back to their home country, which means selling of the Australian dollar. So if we have a look at the intraday graph of the Australian market versus the Australian dollar, I've just got the Australian market on top and the Australian dollar down the bottom in blue, and you can see that basically we did see a movement together throughout the session. So altogether it does look like a lot of offshore action, especially in that futures market and the Aussie dollar and the Australian equity markets. We saw that avoid of that commodity space.
No surprise, sector of the market that was in focus today, that buildings material space. We heard from CSR, $147 million net loss this year as compared to a profit a year earlier. But I guess if you're looking for a silver lining, Julia, this is one of those companies that could benefit from a weaker Australian dollar, right?
Absolutely. If we have a look at CSR, yes, they've come out with a full-year net loss of $147 million. If you strip out the non-reoccurring items, then we did see a profit of just over that $30 million mark. In fact, coming in at $33 million. So that was slightly ahead of our expectations, even though it did represent a fall of 64%. But if we have a look at CSR as a business, we know that the building construction space, it's having trouble there. It's trying to turn around its glass business, but this isn't something that's going to happen overnight. This is more of a 2-year plan, and really if you're investing in CSR at this point, what you believe is that we are near the cyclical low or at the cyclical low in terms of that building construction cycle, and what we will see is recovery in that space, and with CSR leveraged to that building construction activity, and once we start to see a recovery, it'll start to benefit. And as you mentioned, Nadine, it's also exposed to that Australian dollar, so it is a leveraged play into that Australian dollar. So as we see that Australian dollar weakening off, that's good news for CSR's business. Today the stock down by about 0.8%, but I think the actual result coming in slightly ahead of expectations. CSR does sit in the industrial space, so we did see that whole sector being sold off today.
Okay, and quickly, Julia, before we lose, you can't go without talking about CBA. Credit Suisse says that bank earnings are really reaching their limits. Bad debts as low as they can go. Margin expansion is really fading, and competition is heating up as well when it comes to that space. What do you think? What do you make of CBA's result today?
I think a fantastic set of results, and it's hard to be bearish on CBA based on the fact that we're probably at the low of the credit cycle. What we are still seeing is very low, moderate credit growth. If we have a look at the retail part of its business, we're seeing moderate system growth there. If we have a look at the commercial part of its business, we're seeing low credit growth there. So as the credit cycle turns up, then we are going to see these banks benefiting from that type of environment. You're absolutely right that we're not going to see much of a lift from the bad debt part of its business. We're probably not going to see a huge rise in terms of the net interest margin, but hopefully we'll see demand picking up and we'll see credit conditions are picking up, and that should be good news in terms of the banks. We have talked about valuations for a while, but based on these results, I guess the high yield story is not over, and CBA certainly has the capacity to be able to support its dividends. $1.9 billion cash profit. It's interesting to note that if we look 10 years ago in 2003, its full-year profit would have been around that $2 billion mark, and here we get a quarterly number at $1.9 billion.